So we are starting with dividend decision. Okay, so basically this chapter's name is dividend decision, but we have to also consider the valuation of shares. Means they are teaching us what is the valuation of shares, how you will value, because ultimately we are calculating the price of the share. Okay, so now understand, if you remember when we started with the FM, at that time two confusions were there: profit maximization or shareholders wealth maximization. So this chapter focuses on shareholders wealth maximization. Okay, this chapter focuses on what? Shareholders wealth maximization. Fine. Now please understand, there are certain ratios which I want to revise, so I have written it on the screen and you can copy this. Okay, see, dividend per share is what? Total equity dividend upon number of equity shares. Total equity dividend upon number of equity shares. Okay, then you have dividend rate. Dividend rate is how it is decided, based on face value. It's not based on market price. Market price so every day changes. Face value is 100. Face value is 100. Then if I pay on 100 5, then 5% is my dividend. Okay, then we have dividend yield. Yield is based on what? Market price. DPS upon MPS. Okay, DPS upon MPS. Yield means return. Return is based on investment. My investment is what? Market price per share. Then you have dividend payout ratio, means what we are paying out. So DPS upon EPS, that is out of the earnings how much I am paying out. Then you have retention ratio, that is 1 minus dividend payout ratio. Okay, now see what happens. There is something called as clientele effect. Clientele effect means what? Clientele effect means a company, what happens if let's say the company pays the dividend and it is regularly paying the dividend. Okay, so over a period the people have the perception that this company pays the dividend. So who will be investing in that company? The people who expect the dividend. Okay, so there is a concentration of investor in the company. Okay, with the dividend policy that matches their preference. Okay, now their preference is what? They want dividend. So that process is called clientele effect. What it is called? Clientele effect. Okay, clientele effect means what? Concentration of investors, same like-minded investors coming together and investing in the company is called clientele effect. Okay, now all the investors have diverse means their preferences are diverse. Okay, different preferences they have. Same way according to dividend also, based on dividend also they might have different preferences. Some might be wanting dividend, some might not be wanting dividend. Some people might be wanting constant per share dividend. Okay, that is every year I should get per share 5 rupees. Okay, so preferences might be different. Okay, so what happens in this process with the clientele effect? The firm gets investors that they deserve. Okay, and it is difficult for a firm to change an established dividend policy. You can't change the, means if let's say company is paying the dividend and in between it stops paying dividend, then the investor will be very upset. Okay, so if you are continuously paying the dividend, there is a perception and investors come to you so that you are paying the dividend, and if you don't pay, then it will be a problem. So there is perception. Established dividend policy should be followed. Therefore what happens, you know friends, whenever let's say any company, if they are paying a bonus dividend, extra dividend, they will always tell in the AGM that this bonus is for only 1 year because of extra earnings. We don't know whether we will be able to pay this next year or not, so that the investors does not have the perception. Okay, now there are different dividend policies. Okay, now dividend policies means what? See, there is something called as stable dividend policy. Why stable dividend policy? Stable means what? Regular. Stable means what? Regular. Regularly you are paying what? Dividend. Regularly you are paying what? Dividend. Okay, some dividend you pay annually. Okay, even if the amount fluctuates from year to year now, but you are paying some dividend, that is called stable dividend. It's not necessary that same amount you have to pay. Okay, in that some companies what they do, they pay continuously constant dividend per share. Means per share I will pay 4 rupees. So every year they pay 4. If the earnings over a period increases, they can change from 4 to 6. That is possible, but it is called constant dividend per share policy. What we call constant dividend per share policy. Dividend per share is constant. Another is constant dividend payout, means from the earnings how much I am paying. Let's say if my earnings is 50, okay, and my dividend payout is 20%, so I will get, the investor will get dividend per share 10. Again next year earnings has increased to 60 and dividend payout ratio is 20%, which is constant. Okay, which is constant, so the dividend per share will be 12. Okay, so some investors might prefer this. Okay, one more policy is there where we have a constant dividend per share plus extra dividend whenever there is extra earnings. Okay, so this is how the three things are there. One is constant DPS, one is constant dividend payout ratio, and third one is constant dividend per share plus extra dividend. Okay, the first model what we are going to learn is traditional model, which is called Graham and Dodd model. What it is called? Graham and Dodd model. Okay, in this also if you see, we are calculating the price. What we are calculating? Price. Now here the M is the multiple. M is what? The multiple. Okay, and D is dividend, E is earnings. If you watch closely the formula, what is happening is price is equals to multiple into D, that is dividend, E by 3. Means if dividend is 3 times, earnings is divided by 3, that means weight given to earning is 1, weight given to dividend is 3 times. Understood? Now that is a subjective matter. Graham and Dodd felt, so they have given this. Only the reasoning what they have given is that people prefer recent dividend, nearby dividend more than the distant dividend. Understood? The future dividend. Obviously, if you know you are getting something in 1 year and something you are going to get after 5 years, you are more sure about what you are going to get in a year. Okay, so therefore they say that dividend will be more weighted than the earnings. Fine. So multiple is also subjective. Okay, multiple, it will be given in the exam. Fine. So this much I want you to copy, but before that let's do one more model and then I will give you time to copy this. There is something called as Walter's model. Okay, now what Walter says, Walter has two perceptions. He says that either the dividend payout should be 0 or the dividend payout should be 100%. Either it is 0 or 100, in between nothing is there. Okay, so what is the formula he is giving? You know, P is equals to D plus R upon K, E minus earnings minus dividend upon the whole divided by K. Okay, now understand, P means price, D means dividend, E means earnings. Okay, R means what? R means return of investment. Please understand, both are percentages, R and K. But what is R and what is K? R means what the company is able to generate, the return on capital employed, return on investment. And K is what? K is what the investor is expecting. Okay, so there is a difference, R and K. Okay, see, now what they are doing, see, this is retained earnings. From earnings what I paid is retained earning. That is divided by KE, investor's expectation. On that R is multiplied. This much is company generating. And plus what? D, the whole divided by KE. Okay, now understand, R is, if R is greater than K, R is greater than K means what? What the company is generating is 20%, what the investor expects is 15%, then it is called growth firm. And the dividend is what? 0%. If let's say, if your R means the company is generating R and it is equals to K, okay, then it is a normal firm, then it is called normal firm. Okay, and if R is less than K, okay, that means company is not generating that much return, then it is called declining firm. Then it is called what? Declining firm. Okay, then you should pay 100% dividend. Why? I'll tell you. Listen, understand the logic. If you remember initially what I discussed, that the ultimate goal here is shareholders wealth maximization. Come to the first example. See, in that example I have taken 20 and 15. Company can generate 20% return. Company can generate 20% return. I am the company, I can generate 20%. You are the shareholder. Your opportunity cost, what you can earn outside is 15%. So if I pay you the dividend, you will invest at 15%. But if the company retains, then company will generate on that 20%. So therefore, the dividend payout should be 0. The reverse case, if let's say company is generating 15, but investor can generate 20, then 100% dividend should be given, because ultimately when I pay the dividend, the investor will invest it at a more rate, higher rate, and it will ultimately maximize his wealth. So therefore, please understand, this is what you have to understand. Okay, this is how the dividend is decided, whether the dividend should be paid or not. Okay, 1 minute. Now complete this. I'll give you time. Please copy this. Okay. let's go ahead. Please write. Walter says, please write, Walter says, this is summary, huh? This is what? Summary of the theory, okay? Because MCQ questions are going to be there, so you have to be careful, okay? First, only equity firm, that is no debt. Second, earnings and dividend will be constant. This is the assumption, earnings and dividend will be constant. Only two policies, that is if R is greater than KE, 0% dividend, R is less than KE, 100% dividend. Please write this. Done. See the question number 1 in your book. Go to the question number 1, Walter's formula. Go to the question number 1, Vasista Limited. I am reading the question. Vasista Limited was started a year back with equity capital of 40 lakhs. The other details are as under. Okay, so the equity, only equity, see, it's 40 lakhs. Earnings of the company is 4 lakhs. Dividend paid, okay, is 3 lakh 20. P ratio, price to earning ratio is 12.5. Number of shares is 40,000. What I have to find is MPS. Earnings is how much? Earnings is said as rupees 4 lakhs. Okay, P ratio is equals to 12.5. Dividend paid is equals to 3,20,000 and number of shares is equals to 40,000. Okay, so they are asking current market price. Okay, also they are saying find whether the company's dividend payout is optimal. Use Walter's formula. Clearly it is called what? Walter's formula. Okay, 1 minute. How we will calculate R? What is the company earnings? Company's earnings divided by equity capital. Earnings divided by equity capital, because only equity, right? So earnings is 4 lakhs. How much is the equity capital? 40,000 I have, correct? How much I have? 40,000 number of shares I have, right now? 40, and equity capital also they said 40 lakhs. So that means 40 lakhs is directly given. Equity capital is 40 lakhs. Into 100, the company is earning 10%. The company is earning how much? 10%. Okay. %. Okay. Next. Now, if you remember whether the dividend payout is optimal or not, how we will find R and K, correct? We should find K. If you remember, in K there were different approaches. One formula in cost of capital was D by P. Okay, so we don't know the price, so this can't be applied. Growth is not given, so Gordon's model can't be applied, right? This also gives you K, but growth is not given, so this can't also be applied, right? Then what is that? CAPM, RF plus RM minus beta into RM minus RF, that also can't be applied. Okay, so if you remember, one more thing was there where we applied this formula, that is 1 upon p. 1 upon p, this is your return. Okay, this is your k, formula for k. So since I know the p, I can write 1 divided by 12.5. okay, if you don't remember, you should go through the cost of capital. Different approaches were given, right? This is one of the way where one of the way to calculate the k, that is 1 upon p. What is the logic? 1 upon p is nothing but e by p. What is your market price divided by earnings? Okay, like this. So 1 by 12.5, how much it is? 8%. How much it is? 8%. 8%. Since R is greater than K, see, the company what it is generating is more than cost of capital. Therefore, dividend payout ratio should be 0%. Dividend payout ratio should be 0%. Okay, dividend payout ratio should be 80%. Yeah, sorry, dividend payout ratio should be 0. Okay. I have to apply the Walters formula. Now some people now, those who think and those who study, okay, what they will say, sir, market price I have to calculate now. I know the earnings. So I know the earnings, I know the number of share. So I can calculate EPS. Okay, if I know the P, I can calculate the market price. Understand? See, P I know. So from the P, if I know EPS, if P is 12.5, if I know the earnings, because 4 lakh divided by 40,000 is 10, so price is 125. This also you can calculate, but this is wrong. Since they have clearly given that you have to calculate using Walters formula, therefore you have to apply the Walters formula. Okay, so first what I'll do, in the Walters formula, what I want, in the Walters formula, what I want is, what is the Walters formula? Check. P is equals to D plus R upon KE into E minus D dividend upon the whole divided by KE. R I know, KE I know. Okay, what I should calculate is DPS and EPS. So how I can calculate DPS? Dividend per share is equals to, is the dividend given what they have paid? Yes, dividend paid is 3,20,000. 40,000 is the number of shares. Dividend paid upon number of shares, 3,20,000 divided by 8, oh sorry, not 8, 3,20,000 divided by number of shares is 40,000. So answer is 8. Okay, answer is 8. Please copy. Earnings is 4 lakh divided by 40,000. So my EPS is 10. Okay. So now I can apply the formula. Dividend is 8 plus R was 10 upon KE was 8%. Okay. So I'll have to take not 10, I'll have to take 0.1 and 0.1% upon 0.08 into earnings is 10 minus 8, the whole divided by 0.08. Okay. Please calculate. First you will do 10 minus 8. Okay, that is 2. 2 multiplied by 0.1. First you will calculate this 2. 2 multiplied by 0.1 divided by 0.08. Okay, plus 8 and then divided by 0.08. 131.25 should be the answer. 131.25 should be the answer. Okay. if you check here, my conclusion was 0% dividend, right? Payout should be 0. Now currently they are paying current dividend payout, na? See, I'm just cross verifying, not required. But current dividend payout ratio is 8 upon 10. Okay, that is 80%. That is how much? 80%. Okay. Now if you check, what if dividend payout ratio is 100%? Dividend payout ratio is 100%. What if dividend payout ratio is equals to 100%? Now if it is 100%, means 100% I'll pay the dividend. So understand, P is equals to, I'm not writing the formula again. Okay, what I'll do, 100% I'll pay dividend. Means my dividend is full earnings, that is 10, plus 0.1 divided by 0.08 into earnings is 10, dividend is 10. So ultimately this becomes 0. This becomes what? 0. Okay, this becomes 0. And that is divided by 0.08. That is divided by 0.08. Check. Copy. Here you can write DPS is equals to 10. Earnings is also 10. Here I get 125. 125 is the price. 125 is the price. Let us check for this also. What is the price? 80% means 8 is the dividend plus 0.1 divided by 0.08 into 10 is the earnings. Dividend I paid is 8 upon 0.08. Okay, this I have not done, right? This is already done, na? 131.25. Okay, this is not required, means I'm just above we have done. My payout is this, so 131.25. Here my price is 131.25. See what I'm trying to prove. This is 131.25. No need to do it again. Okay, 131.25. Okay, my recommendation was dividend payout should be 0. So what if dividend payout ratio is equals to 0%? That means DPS is equals to 0, EPS is equals to 10. So now I'll calculate the price. Dividend is 0 plus 0.1 divided by 0.08 into 10 minus 0, the whole divided by 0.08. So I am getting here 156.25. You can clearly check, when it was 80%, currently 131 was the price. When 100% was there, 125 was the price. And when it is 0, at that time it is 156. Shareholders' wealth, where it is maximizing? Third case, when the dividend payout is 0. The market price is high. Market price is high. That means shareholder is getting more dividend. Understood? Like that. Okay. Okay, done till here? Okay, let's move into the second question. Okay, see the second question. It is Indira Limited. Question number 2. Indira Limited. Indira Limited has an internal rate of 20%. Now what is internal rate of return? That is what the company is generating. Okay, what the company is generating is 20%. That means my small r is 20%, that is 0.2. Going ahead, listen, they are saying that it declared a dividend of 18% on its equity share, having a face value of 10. So dividend per share is, on 10 I will pay how much? 18%. So 18% comes to how much? Rupees 1.8. Okay, so I'm making the base. The dividend payout ratio is 36%. Dividend payout ratio is equals to 36%. That is DPS upon EPS. DPS upon EPS. So therefore, I can say that EPS is equals to DPS upon 36%. So that is 1.8 divided by 36% comes to how much? What is my EPS? Check. What is my EPS? 1.8 divided by 3.6 comes to rupees 5. So dividend I know, R I know, okay, EPS I know, correct? Let's go ahead. Find the cost of equity. KE you have to find according to Walter's model. Okay, so this time KE we have to find, and P ratio is equals to 7.25. 7.25. So from the P, what I will get? If I know the EPS, I can calculate price. So P is equals to 7.25. My price I don't know, but EPS is, so therefore price is equals to 7.25 multiplied by EPS, that is 5. 5 into 7.25, answer is how much? 5 into 7.25, answer is how much? 36.25. Copy. Let's go ahead. Now all the things are done. I have to find K, remember. So I'll apply my price formula of the Walter's model. So P is equals to D plus R upon K, okay, into what? Into E minus D, the whole divided by K. Okay, so this time I don't know the K. Fine, this time what I don't know? The K. Price is how much? 36.25. In the previous sum, directly you using by P, you can't calculate what your means you can't calculate the price, remember here, but because I want K, so there is no option for me. Using that P only I calculated the price. Okay, now that price I will substitute. Dividend was how much? 1.8, I think. Dividend is 1.8, correct, plus EPS is 5 minus 1.8 into R was 20%, 0.2 upon K, the whole divided by K. Okay, so in simple terms, if K goes to this, K goes here, it becomes 36.25 K is equals to 1.8, okay, plus you have to multiply 0.2 into 5 minus 1.8, 5 minus 1.8 into 0.2, 5 minus 1.8 into 0.2, 0.64 upon KE. Okay, multiplying, later you can copy, multiplying the full equation by KE. So when I multiply the full equation by KE, what happens? Understand. So 36.25 KE multiplied by KE becomes KE square. 1.8 into KE becomes 1.8 KE plus 0.64 upon K into K. K gets cancelled. Understood? So this is how it will work. Fine. So now it has become a quadratic equation. What it has become? Quadratic equation. Okay. So how we will solve? Obviously you should know quadratic equation formula, otherwise you will not be able to solve. 36.25 K square minus 1.8 K plus 0.64 is equals to 0. So if you remember, x is equals to minus b plus minus under root b square minus 4ac upon 2a. This is formula for quadratic equation. Okay, if this sum comes, you should remember this formula. Okay, this is your a, this is your B, and this is your C. Okay, so first I'll calculate B square minus 4AC. Okay, what I'll calculate? B square minus 4AC. So B square means minus 1.8 the whole square. B is minus 1.8. Remember, minus 4, what is there in the formula, into A is 36.25 multiplied by C is 0.64. Okay, so check how much you are getting. 1.8 the whole square, and then multiply that right hand side. What is after the not right hand side, after the minus, 4 into 36.25 into 0.64, 96.04, 96.04, 96.04. So x is equals to, again formula, minus b, minus into minus 1.8 becomes plus, okay, minus, okay, plus or minus under root 96.04, I'll have to take the root, upon 2 into a means 2 into 36.25. okay, so two answers are there. 1.8 plus, take the root of 96.04, it will be 9.8 upon, let me write here minus, upon 2 into 36.25 becomes 72.5. okay, 72.5. So there are two answers for you, that is 1.8 plus 9.8 upon 72.5, and or I can say 1.8 minus 9.8 upon 72.5. So first answer is 16% approximately, and this is negative minus 11.03 if you check. Okay, negative is not possible, the rate can't be negative, therefore we have to accept this positive. Okay, we have to accept this. Fine, I'll give you time to write. Okay, so we have to accept this. Okay, in the question what they have said, find the K to alter model and hence determine the limiting value of the share. Limiting value means when the dividend payout is 0 and when the dividend payout is 100, what is the value of the share, okay, of the said model. So let us do that. Okay, so I'm not writing, I have not written the formula, I have written it once, so I'm not writing the formula one more time. Okay, once you write in the exam is more than enough. Okay, so calculation of limiting value. Calculation of limiting value. So when dividend payout is equals to 0%, when dividend payout is equals to 100%, like this. Okay, so here the DPS would be 0, correct, earnings was 5, so full 100% I'll pay dividend. Okay, understood. Then I will apply the formula, which Walter's formula. 0 plus R was 0.2 divided by 0.16 into 5 minus 0, dividend is 5, oh sorry, earnings is 5, dividend is 0, 0.16. Check the answer. Rupees 39.06, rupees 39.06, and here you will get 5 is my dividend, 0.2 divided by 0.16, 5 is earnings and dividend is 5, so ultimately what is left? 0. Okay, so actually now this part you should not calculate. Actually what you should do, when it is 100%, whatever is the dividend divided by K, dividend K divided by K. Okay, so it comes to how much? Rupees 31.25, 31.25. So see here it is maximum. If you check, R is greater than K, so what we have learned, that dividend payout should be 0 and it is justified. Check, see here it is justified. Okay, like this. So R is greater than 0, therefore you should not pay the dividend payout should be 0, and see the shareholders wealth is maximizing the share price where it is maximum, at the 0% dividend. Okay, so this is what you have to copy. Okay, please copy. Okay, let's move ahead. Let's go to the next question. Okay, see, again the question is same. Question number 3. Maya has a equity capitalization rate of 12%. That means K is 12%. Okay, earnings of the company is 10 lakhs. Earnings is given, number of shares is given, so I can calculate EPS, that is earnings divided by number of shares. Earnings divided by number of shares. Okay, number of shares. So earnings is how much? Earnings is 10 lakhs divided by number of shares is 2 lakhs. So earnings comes to rupees 5. This all base work now you should do in the exam, so that there is no waste of time and instantly you can pick the data. Okay, so earnings we have calculated rupees 5. Then dividend payout ratio. Dividend payout ratio is equals to 60%. Okay, that means DPS is equals to whatever is the earnings, out of that 60% you get the dividend. So rupees 5 multiplied by 60%, your answer should be 3. Your answer should be 3, correct? So DPS also I got, right? Now answer is 3. Next, return on investment means my small r, that is 0.15, that is 15%. What is the market value per share as per Walter's model? Okay, what is the optimum dividend payout according to Walter model, and market value of the company share at payout ratio, at that payout ratio? What would be the optimal? Okay, see, R is greater, so the dividend payout should be 0. So when dividend payout is 0, what is your market price? That is what the second question is. Okay, and in the current scenario, what is the market price? Fine. So what I will do is I'll apply the formula for the A part. Okay, you can write it later. P is equals to D plus R upon KE into E minus D, the whole divided by KE. Okay, the whole divided by KE. Fine. So dividend per share is 3 plus return is 15%. 0.15 divided by 12% is K into earnings was 5 minus 3, the whole divided by 0.12. Okay, so here you should get rupees 45.83. How much you should get? 45.83. Okay, check whether you are getting 45.83 or not. R is greater than KE. Okay, therefore dividend payout ratio should be is equals to 0%. Okay, so they are asking at 0% what is the price. So dividend payout ratio is equals to dividend per share is 0. Okay, EPS we know. Directly I will do. Come on, let's do it. Directly I will apply the formula. P is equals to dividend will be 0 plus, okay, payout is 0. Okay, payout is what? 0. So 0 plus 0.15 upon 0.12, that is R upon K, into 5 minus how much is the dividend paid? 0. So divided by 0.12. So check the answer. 5 into 0.15 divided by 0.12, the whole divided by 0.12. 5 minus 0 is 5 into 0.15 divided by 0.12, again divided by 0.12. So you will get rupees 52.08. Okay, this is the price, second part answer. Okay, then the next part we have already done. The next formula we know that. Okay, that is in cost of capital we have done. I have proved that. Okay, that formula also, that is, please wait, you copy this first. Okay, wait, copy this first.